as well. Okay, so everybody, we're here for the May AHA with Amplify webinar. I'm very excited that we have the opportunity to hear from Pamela on a very important subject. So we're talking about uncovering tax efficiency and the hidden wealth strategies. So this is a great opportunity for all of you that are business owners, or if you're a CPA or business leader supporting founders or business owners, this is the absolute awesomest hour for you. And for those of you that might eventually be in a situation where you need to unlock your tax efficiencies, even at a personal level, or look at your own wealth, I think there's going to be a lot for you to benefit from as well. So we're really, really happy to talk about this important subject today. What's coming up next before we jump into today's topic? We have June, our final webinar of the season, and we're very thrilled to be maximizing client outcomes with Shred and clean economy ITCs. So we're really excited to have the experts come and join us in June to wrap up our season. What I would like to point out is even if you think Shred is not applicable to your organization or your current role, I do welcome you to come and learn a bit about it. One of the things we see frequently is that there is opportunities with Shred, but people don't recognize them. The good news is you don't get penalties and consequences if you don't do Shred, but there's a lot of money being left on the table when you don't understand if you're applicable. So please join us, even if you're sure that today you don't apply or need to know Shred, because I think it will be great for your career and potentially you might see something that you didn't realize. So please join us for Shred. It will be the wrap up of our webinar series for this season. We take July and August off, as all of you know, because we hope that you're too busy on the golf course or at the lake or with your kids to be hanging out with us and doing your CPD and your business learning. So July and August, we're off. And then I anticipate an amazing season that our growth team will be putting together for Amplify's next season, which will start promptly in September, which is the real new year, as we all know. So with school, with hockey, with everything else that's starting in September, so will AHA with Amplify. So be sure to join us in June. Enjoy your summer of July and August, and come back to us in the fall in September. In the meantime, we also have a lunch and learn. We are going to do an Acumatica lunch and learn on June 2nd. So if you're not familiar with emerging ERPs or Acumatica in particular, this is a safe, no commitment environment for you to learn what it is that we're doing with Acumatica. So please do look for that. Nikki's going to post all of this in the chat. We're really, really excited to share Acumatica. As many of you know, we are a gold partner. This has been a great achievement over the last year. We've been implementing systems in all industries, but we're specifically excited about the project-based industries. So construction, field services, oil and gas services, environmental services, those types of companies that work with projects. Oh my goodness, Acumatica is the best solution for those companies. And frankly, that's one of the driving reasons why we became an Acumatica partner. We weren't winning because we shouldn't have been winning when we were competing against Acumatica, because it was the best solution. And so we're really thrilled that we can now compete and win and help clients in the project-based areas, which includes construction, field services, oil and gas services, environmental services, and any of you that deal with projects in order to make your revenue and serve your clients. So Acumatica is just awesome. Really excited for you to share in this excitement and to see it. So June 2nd is a lunch and learn, no commitment. If you don't want to get into a sales process and talk to our growth consultants one-on-one, here's a chance just to see it and observe and decide if it might be right for you and your company. So 2 things coming up, our June final, and that Shred, that is going to be on the 17th, the 3rd Tuesday, like it always is, like we are here today. And then the Acumatica Lunch and Learn June 2nd, and we'll be back in the fall with all kinds of things, events, webinars, and whatever we can do to support our community. In the meantime, Pamela, very excited to have you here. Let's get rolling.
Okay. let's get started here. I think I have to do this first. And this. I'm getting there, sharing.
Looking good. I'll confirm and then I'll go off screen and let you roll.
Okay.
We're good.
You should be good right now.
Thank you.
Okay, I'm here to talk about wealth strategies. I gotta go see if this works. Okay. So my name is Pam Coquet. I am a CFP, so a certified financial planner. I'm a wealth manager and an insurance advisor. So I kind of do it all. In my practice, my number one thing I focus on is financial planning. And then with the financial planning, again, I look at investments. I do retirement planning, there's tax planning, cash flow planning, estate and legacy planning, and then charitable giving. And also another big component is business succession. That is not the topic of our conversation today, but just to let you know that I really do focus my business on the whole picture. Okay, and then we can get into the nitty-gritty. So today, we're going to talk about wealth strategies, which are TFSAs and RSPs. I'm kidding. We're actually not going to talk about those because you guys all know about TFSAs and RSPs, and there is such a big array of strategies out there that I feel that people just don't talk about enough. Okay, so what we're really going to start on again is financial planning. This is the bread and butter of what I do. It's what I love. It's my passion. So with financial planning, because I do investments as well, so I really wanted to just start off talking about what the difference is between an investment advisor and a financial planner. So an investment advisor, their focus is talking about investments, try to get you the best rate of return within the platform. What a financial planner does is look at everything. We're going to look at short and long-term goals, retirement, cash flow planning, risk management, because if we don't do that, then the whole portfolio could fall apart. We look at private corporations, because again, in Alberta, in Canada actually, there's a lot of people who are self-employed who have their own corporations, whether it's a sole proprietor or they could have employees that have multiple employees in there. A planner will also run those what if scenarios. What if your investments don't get a 5, 6, 7% rate of return? How does everything work? We work on estate planning. We put it all together. And so what's really important is that with investment, again, it's working on what stocks, what bonds, what mutual funds are you going to have? Whereas what I look at the holistic. Want to make sure. So if you have a corporation, okay, you keep the investments within your corporation, or do you take it out, pay tax, and then invest it personally? Because there's different strategies behind it. It might be a combination of both, but an investment person will only be looking at those investments, not where the best tax strategy is. So for example, in a corporation with a specific client, I might say, okay, let's put in a corporate investment held within your corporation. And so in there, maybe my goal is to build up some CDA credits, the capital dividend account, because I know this client is going to be needing to take some money out, whether it's when they're selling. So by putting that investment in there, the strategy might be to build up the CDA. Again, whereas an investment person, very important because I do that too, only looks at that. So I'm going to leave it at that. But again, it's just really important that we understand that a planner works with an advisor, investment advisor, and an insurance person and an account. We bring it all together. And that's what a lot of these strategies that I'm going to talk about is about bringing things together. I love stories. I feel stories are the best way for us to really understand a concept. So we're going to talk about Fatima and Jacob. Fatima sold a rental property and she has a capital gain. Jacob has a stock in his portfolio that it's sitting at a loss, but he doesn't want to sell it. So what are we going to do? One has a gain and the other, Jacob's like, yeah, I could give it a loss and give it to you, but I really don't want to lose my stock. I think it's going to appreciate over time. So a solution is using the superficial loss and the attribution rules to their advantage. You have to follow these steps, very carefully, but you sell the stock on day 1, buy it back in day 2, and then on day 31, you sell it. And I'll show you how it works. So Jacob has his stock. He bought it for $20,000, but now it's only worth $5,000. So he has a $15,000 capital loss. So what he does is he sells it. Then Fatima goes in and she buys the exact same stock, and she does it right away. Ideally within 30 days, but it has to be within 30 days, but ideally as fast as we can. So she's going to buy it for $5,000. He sold it for $5,000. She buys it back for $5,000. Now it's in her portfolio. Because of the superficial loss rules, is that he's not allowed to claim this loss. It's denied because the government doesn't want you having an investment and then you sell it, claim the loss, and then just buy it back right away so you can get all the appreciation. It's a double dipping. So the government says, absolutely not, you're not allowed to do it. So Jacob's loss is denied. But Fatima owns it. So on day 31, to pass that 30-day superficial loss rule, Fatima sells it. And let's say it still sells. It hasn't appreciated in value. She sells it for $5,000. What the rules say is that because it was denied to him, it goes back to Fatima. So now, even though Fatima only paid $5,000 for it, that loss of $15,000 goes back to her. So now her true cost is $20,000, but she just sold it for $5,000. And now what has happened is she now gets to claim the loss on that investment. So Fatima now has the loss of the $15,000 that she can write off against her capital gain. And Jacob still gets to, he's not owning it, but within their family, still gets to hold that one stock so that it can appreciate for future growth. So it's little things like this is why it's so important to work with a financial advisor and a wealth person, have everybody working together. We would probably even bring in the accountant to make sure the accountant knows, because the wealth advisor wouldn't know necessarily that Fatima would have a capital gain from selling her rental property. Here's another strategy. This is called an individual pension plan. They're called IPPs. I absolutely love IPPs. It's exactly what it says. It is a pension plan for an individual. So if you work for the government, you have a pension plan. So what our government has said is, well, we also have these people who own their corporations. They should be allowed to have a pension plan as well. So that is what this one is. These ones are spectacular because I call it a supercharged RRSP. There's more money that you can put into it compared to an RSP, and we'll talk about that in a bit. It creates more tax-deductible contribution room. So it can go up to over 64% more money can go into an IPP than an RSP. So this is a really good strategy, again, for business owners, because you tend to earn a lot of money. And the RSP in general, you can only put maximum $32,000 into it. So using an IPP, you can put 64% more up to. It is fully funded by the company, so you don't need to take the money out personally and then invest it. It can all stay within the corporation. It is a defined benefit pension. So this is really important. And this is what also makes it a very supercharged RSP, is that you can add in family members. So it can create intergenerational wealth. And what's better than an RSP is that it can be set up to index to inflation. So that is all the advantages for the employees, but what's the employer? So even though this is an individual, so you have a person that, say for myself, I have a corporation. I can set up the IPP in my corporation. So I am an employee of the corporation, but I'm also the owner. So the IPP is set up for me as the employee. But for me, as the employer who owns the corporation, I get to write off all the contributions. So as the employee, I don't need to. It's all done. All the fees, all the contributions, everything gets to be written off by the employer. and the whole thing is creditor protected. So RSPs aren't always creditor protected. There's some little hiccups to it. Whereas with this, it falls under the pension plan regulations, so it is creditor protected. And IPPs are a really good way for the employer if you want to sell your corporation later on, and maybe you don't meet the lifetime capital gains exemption for the passive income. This is a really good way to pull that passive income out. So you don't necessarily have to take it out of the corporation. What you're doing is you're just putting it inside the corporation with a bubble wrapped around an IPP, which takes away the passive income. It's utilizing it. So an IPP is ideal for business owners and incorporated professionals. You can use it with key employees, but just have to be very careful. So it's something that we deal with on a case-by-case scenario. But in general, business owners and incorporated professionals are perfect. People over the age of 40, because generally under the age of 40, you're going to get more contribution room in an RSP. But after 40, this is where the IPP becomes more beneficial. And in general, we want everyone to be earning at least $100,000 in T4 income, not dividends. We need T4 income to make this work. And this is how it works. So you have a sponsoring company, which is, say, for example, my corporation. My corporation puts the contributions in to the IPP. And then when I go to retire, the IPP is the defined benefit, will pay me out how much I want to myself. So the sponsoring company is my corporation and I'm the retired member. So the sponsoring company puts the contributions in, they get the tax deduction, sits in the IPP, and then the withdrawals are taxed to me when I pull it out. Okay. So there's contributions. So again, the contributions, how much you can put in is calculated by the actuaries. It's not a random amount. They do the due diligence all the time to make sure that you are contributing the right amount and you're not contributing too much. And the whole IPP is not managed by the sponsoring company. So my company wouldn't be managing it. It is a separate entity who does it. So there is no work put onto the sponsoring company. Let's see how it works in a little bit more detail. So before retirement, so I'm not pulling out any money. This is just an example, baseline example. So if, say, I am 50 and the maximum I can put into an RSP is $32,490 based on the 2025 girls. In an IPP, I'd be able to put in $48,800. So that is a $10,000 difference of how much more I can put into an IPP. Say if I was 65, I'd be able to put in 67% more into the IPP. And again, this changes with everybody. Sometimes these numbers are a lot more because the actuaries are going in there and looking at past service. They're looking at how much RSPs you have. They're looking at your age. They're looking at your income. So it is different for everybody. But in general, this is just a good idea to give you an idea of how much you can put into them. What supercharges it? Past service. So up above, this is how much you can contribute potentially every single year. But it also, when you set up an IPP, can create past service room. And it can go back again based on T4 income all the way back to 1991. So for example, in the same situation, say I'm 50, I can put in $48,800 a year, plus I could potentially have $233,000 of money that I could just put into it. So say if I have a corporation, my corporation is sitting on some passive assets. So I could take $233,000 right out of my corporate bank account and put into the IPP, plus put in this $48,000 a year, getting a tax write-off for both. Whereas you look at an RSP, you don't get past contribution. You kind of do, but not in the same sense. You only get past contribution room in an RSP of what your T4 was based on, again, the maximums that you could put into a year. Here, your maximums are going to be higher, and there's a whole bunch of other calculations to make this amount larger. And the other thing is it has top-ups. So CRA ideally would like the IPP to be earning a 7.5% rate of return. But we all know investments go up and down. And what if you're a conservative investor and you just don't want to be putting something that's a little bit more high risk? So you have the opportunity, but not the obligation. If your IPP is not reaching the 7.5% rate of return, the actuaries are going to come back and say, okay, based on that, to hit the funding levels, the amount of money, they allow you to put even more money into the IPP. So again, you can either attain that by getting a high rate of return, or if, again, we're trying to pull out money out of your corporation, we can use it as past service, and we can also use it as top up. So maybe we might strategically say we don't want to hit a 7.5% rate of return because we're trying to get the money out of the corporation into the IPP so that it's tax deferred and gets your corporation tax deductions. Right before retirement, so right at the time you retire. So what we're talking about before is what you can do to add more money while it's growing. But when you get to retirement, you also have other ways to supercharge your IPP. It's also called terminal funding. Before you retire, you can say, okay, I have this end date. You know what? I want to make sure, because this is a defined benefit pension, you want to index it to inflation. And I have this pretty little chart here that I have taken from the Bank of Canada. I use it all the time with my clients. What it's showing is that the Bank of Canada really wants inflation to be sitting at 2%. As you can see here, we have some really big spikes that have happened in our recent past that have made it go up. We have times where inflation has been down, but it's these big spikes, anything over 2%, that are cause for concern. Because when I do portfolios and when I do financial plans, I'm always looking at, okay, if you think things are going to cost this much, but in retirement they start doubling, which we have seen, that's going to start depleting all of your investments. This is why I really like my clients having CPP and old age security, because they are indexed to inflation. You can also take your IPP and create one more source of income that is indexed to inflation. And to do so, you can, if you want, put more money into your IPP, again, taking that money out of your corporation, all those passive assets, and then putting into this so that you can have inflation protection. You can also do, again, because it's a pension, you can do a bridge pension. So if you decide to retire before the age of 65, you can put more money into your IPP. You can do any of these if you wanted to, without putting more money in. But again, this is a way to supercharge. We're trying to create something with as much capacity to put as much money in as we can so that you can have it tax deferred for as long as we can. And again, giving the corporation tax write-offs. You can also set up a bridge pension. So again, if you retire at 60, but your CPP and say you retire at 55, your CPP and old age security don't kick in. So you can create additional funding so that it gives you the same amount of income that your CPP and old age security will at, say, 65. So it's bridging that gap. So again, an opportunity to put more money into your IPP. And survivorship is a pension. So if you have a spouse, when you pass away, you can have survivorship, meaning that if you can go up to 100%, so that if you pass away, your spouse is going to get the exact same amount you were getting from your pension for the lifespan of their lives. And again, if you wanted to, creates more capacity to put money into the IPP just before you retire. So we're going back to this screen. Talking about as the company, so again, my corporation, I'm doing the contributions. Where do I get the deduction? You get deductions for current service, for all of the top ups. So your current services, I'm putting in $48,000 a year. That is any top up. So if I put in $233,000 as my past service, I get a tax deduction for that. It's also important to note that there's no payroll taxes. So putting this money in is not, for me as the employee, it's not being charged as income to me. It's not a taxable benefit. And so that means, again, you don't have to pay payroll taxes on it. And again, your past service, your terminal funding, which is everything we just talked about with the indexing, and all the fees. So there's a company that I use for IPPs called GBL. Absolutely, I think, in my opinion, one of the best companies. So I use them all the time. So their fees, as well as the investment in the IPP. So the IPP has, of course, all your money. It is invested. So all of those fees, you get to write off as well. So again, the investments. The investments are chosen by the employee. So again, you can set up an IPP. If I own the corporation, I can set it up for my business partner. I can set it up for other people in the company, again, depending on if they meet some of the rules. But you can choose. Each person will have their own, and they can choose whatever they want to invest in, whatever fits their needs. And it's a wide range of investments. You are not limited in general by what you can invest in. And again, like I said, I love it because it's also creditor protected. Owning a corporation, there are multiple reasons why you could have some sort of litigation against you. This way, you are just protecting. And again, talking about being a financial planner, one of the things we look at is not just the investments. I'm looking at how can I protect your wealth? Because again, you can have the money now, but if your company gets sued, that's the first thing they're going to talk to. I have one of my clients was sitting, he had over $4 million just as a safety net sitting in his corporation's bank account. And he's been sitting on it for a long time, the what if scenario. But the problem with that is that if he gets sued, that's the first thing that's going to go away. It's the easiest, the most liquid. So this is creating a creditor protection of all of your hard-earned money. And it's tax deferred. Like an RSP, you don't pay tax as it goes in, don't pay tax as it grows. You pay tax when you withdraw it. And again, you can supercharge it. An example. Today we have Christy, who's 55. She's a partner in a small geoengineering firm. She makes $180,000 a year, and she's got about $300,000 in RSPs. Her company pays out bonuses each year. So what she's concerned about is she can only put $32,490 into her RSP. What other options does she have to bring her taxes down when she gets her bonuses? And again, solution, ta-da, is an IPP. So what we would do is we'd set up an IPP and direct all of her bonuses to it. So again, her corporation, so the corporation would set up the IPP, and instead of paying her the bonus, she can still get her salary. We'll just take the bonus and put the bonus into the IPP. Based on all the actuarial numbers, Christy could have $63,000 in contribution each year. So every year she can put in $63,000. But it has also created $294,000 in past service room. So she doesn't have to use that right away when the IPP is set up. She can invest it over time. So if her bonus, so she gets to put in she has every year $63,000, but what if her bonus is 100? She can still put that 100 into the IPP, not paying any taxes on it. It's all tax deferred. Her corporation gets a tax deduction for the $63,000, plus that difference is from the past service. They get a tax deduction for putting that in there, and she doesn't pay taxes on it either. And again, another way, if she has a really big bonus and say it's $150,000, she can use up this past service, or if over time she's used it up, if she doesn't get a 7.5% rate of return, she can open up contribution room because she didn't get a 7.5% rate of return, put some of her bonus into it. So again, the employer still receives the full tax deduction for paying her out the bonus, and they don't pay any payroll taxes again. And Chrissy doesn't report it as T4 income. So this helps keep her taxes down. And as a result, she's starting to build more and more I like to say buckets of retirement money. When things happen like the last few years, I like to put money into buckets. We like putting some into cash. I like putting some into short term, something that is not as risky, a little bit more fixed equities, and something that can actually grow. But on top of that, I want to see things in TFSAs, RSPs. I want non-registers. I want CPP, old age security. I want all these differences. And what I like about the IPP is it creates another bucket for retirement investments. So that again, if something happens, I can say, okay, we're not going to take anything out of your RSP because maybe the rates of return or there's something held in there that we just don't want to deplete. Great, we're going to make sure that we have the IPP and we're going to do that so it's got inflation protection. So I like having these buckets because each one has a unique property that helps people in retirement. So like I was saying, an IPP is a really good retirement solution. It creates intergenerational wealth. So again, that could be your spouse, depending which generation they're in. So if I pass away, it can roll over to my spouse and then he would continue on getting the exact same amount. But what about my kids? If my kids are in the business, so if my kids are legitimately working in the business and are shareholders in the business, we can set up IPPs for them as well. And then the company would get tax deductions, same as it would for mine. If I am in retirement and I'm withdrawing from my IPP and I pass away, the IPP can be rolled into my kids as well. So for example, what if my spouse passes away before me? Now the IPP, instead of it being a deemed disposition, like a pension or an RSP being a deemed disposition and being fully taxable, it just rolls over to my kids' IPP and continues on, and there's no tax paid on the disposition. The kids just automatically get it, and then when they retire, now they just have more money and the tax will be paid then. And again, if they did the same thing and they had kids who were in the business, it can keep going on and on and on. So it's a way to help create intergenerational wealth. There are some myths because IPPs have been around forever and there's different names for IPPs, but in general, IPP is the most common name. A lot of people used to think, well, still do think that they are very expensive. They aren't. There is $1,700 to set them up, and then the annual fee is anywhere from $1,000 to $1,700. That's it. You don't have to do any filings with CRA. You don't have to do any accounting stuff. You don't have to manage the investments. There is nothing that the employer really needs to do besides making sure that the bonus is allocated to the IPP. And it's just by giving a number to the, say again, GBL, they take care of it all. So one right here, they're not hard to manage. A lot of people thought they're really cumbersome, and they used to be years and years ago. They are extremely simple. It's none of the work is on the owner of the company, and they're not expensive. GBL does all the actuarial servicing, so they tell you how much you can. They do run all the numbers, and it's all built into that cost. And some people, myth too, used to think that there would be funding liabilities. There's not anymore. IPPs back in the day were set up just like a pension. So if you had a true pension and you had a big corporation, not an IPP, the reason they were defined benefit pensions were the biggest thing that used to be out there. You're seeing more and more companies now using defined contribution, because with a defined benefit, it is a guarantee of how much your employee is going to get in retirement. If the investments within the pension are too low, the company would have to make sure, like put in more money into it. And so that's where this myth was coming up, that there's going to be, as employees, so again, me as a employer, how much money I would have to be in. Because what if I have a really bad year? What if I don't have the money to put into an IPP? Traditional defined benefits, you have to put money in no matter what. Now with an IPP, you don't have to. If I don't want to put money in, I don't have to. Because the way an IPP is built, it's a defined contribution, meaning that the amount that you're going to get in retirement is not defined yet. So a defined contribution means we can just put in money whenever we want, whenever it works for our company. And then when you get to retirement, it switches and it goes into a defined benefit and guarantees you that amount for life. So these three myths are just based on stuff from a long time ago, or people being confused with a traditional defined benefit. But with an IPP, these aren't. Okay, I'm going to stop here. Jamie, does anybody have any questions so far?
Yes, thank you. That was great. So you talked about the cost of setting up an IPP and that it wasn't expensive, but does an IPP convert to a RIF at 72 like the way that RSPs do, or how does that work?
No, with the pension, you can keep it as a pension, you can move it into a LIRA, or you can put it into an annuity. But it doesn't, it will turn into, like, it's a pension, it will, but it's not like an RSP where at 71, it's going to turn into it. So you can kind of decide when you want to retire. You have more flexibility.
Awesome. And also, what happens if we sell the business? How does that work if, for example, if you're the business owner, then you sell the business and you have an IPP and maybe your kids or what have you have an IPP? How does that work with the transaction?
What I do with my business owners is we set up a hold co. Well, you can do one or two things. With it, you can either just make it a pension. So again, if you're not ready to retire yet, then what I would do is if the business owner sells and they don't have another company, then what we would do is just set up a hold co. And then we just pick it up and drop it into the hold co. And it can sit there. If you're selling and then you're retiring, then we can just turn this into a defined benefit and either move it to a LIRA, give the defined benefit income, move it into a LIRA, or we can put into an annuity.
And so going back to that defined benefit, so you talked about like there's not a funding requirement, but yet it's more of a defined benefit. So how does that work if like if my stock does better, I don't get that difference? And if my stock doesn't hit the mark, who's paying that difference?
So in the beginnings, like I said, an IPP is set up as a defined contribution. So how much you're going to get in retirement isn't set yet.
Okay.
It doesn't have to be set. So this is what creates all of that flexibility of,
Right.
okay, how much can we put in? Can we put in a little bit more? Can we supercharge it? Because it's a defined contribution, not a defined benefit. So the difference between the two, a defined contribution, as a lot of pensions out in the general world, a lot of people have a defined contribution means you don't know how much you're going to get, but you know how much you need to put in. And then when you go to retire, it depends on what that nest egg has grown to. Defined benefit for the employer is, okay, based on how many years the employee's been working, how much they've been earning, this is how much they're going to get in retirement, and it's up to the employer to fund it. Having the best of both worlds means in the defined contribution, if your investments that you choose, because it's defined contribution, aren't doing well, you can put more money in. You don't have to because it's defined contribution. You've got the flexibility. If you really want to supercharge it and make sure that by the time you go to retire and it flips into a defined benefit, you just do all that work beforehand, try and throw in as much money as you can.
Okay, so it flips. I get it now. I was misunderstanding
Yeah, it
how it
flips.
starts. So that makes sense. So with the kids, you said that there's that generational opportunity if the kids are in the business. But what happens if your kids are not in the business and unfortunately you're single because of the spouse passing, or maybe fortunately or unfortunately you're always single, I don't know. But how does that work if you don't have a spouse and you don't have kids in the business? And you
The same as it depends on how you put it. So if it's, say, if you retire and you say, I don't want it as a pension, I just want to flip it into a LIRA. Great. So if it's a LIRA, then when you pass away, same rules as a LIRA, that the remaining amount can just goes into your estate, pay the tax, and then goes to your kids. Same thing with the pension. And annuity is a little bit different because it's a life annuity. But if you flip it into a defined benefit or into a LIRA, it just deemed disposition when you sell.
And if you're working actively and not anticipating dying or retiring, same thing, it would it would just go into your estate and go to your children or your
Mhm.
nieces or nephews or whoever you've assigned.
Yeah, it's just a deemed disposition,
Right.
taxable upon death. Yeah.
Okay, perfect. So in the example that you gave, she had 63,000 of room in her IPP. Is that on top of the 30 something she had on her RSPs, or is that kind of an instead situation?
Instead,
Okay.
yeah, you can't do an IPP and an RSP.
You,
They kind of conflict. So I, in general, say we can put more money into an IPP. Let's do it into an IPP rather than an RSP. If somebody is not, doesn't, they only have 32, say the max, $32,000 to invest, and there's no extra past service funding, they have no extra income, then an IPP would not be ideal. It's really good if you can put, if you need to tax shelter more money than what the RSP allows.
okay. And then you said that the person should be making 100,000 on T4 income, which for founders is quite a bit to be paying out on a T4 and generally counter to most other advice. So can you explain a bit as to how, like, why is it 100,000 and does it really make sense if you're a single business owner or maybe just a co-founder? Like, would it actually make sense to have that much T4 income in order to leverage this IPP? Because that's a lot
Yeah,
more than our clients, unless they're in a partnership like your example. But when they're in
right.
small ownership groups, we would never see them give themselves 100,000 of T4 income. That usually doesn't make sense.
Yeah, so it's in general, if they're not bringing in 100,000 of T4 income, so if they're taking it out as dividends and some T4, then we'll have the conversation, do the analysis. But in general, might as well just put it into, I would rather my clients be taking T4 income rather than dividends. Because in the end, it's a tax wash, but dividends don't create CPP and old age security. If in general they're just not taking that much out of their corporation, then the IPP might not be worth it because an RSP will meet all of your needs.
Right. But there's, I mean, I can't remember right now, but the CPP maximum or minimum or however you phrase it is only like 70 grand. So that's an entire 30,000 that you're paying
Right.
employer taxes on and getting no old age and no CPP. So that's an
Yeah.
interesting, I
And
guess,
so that's,
math
we,
that made
yeah,
sense.
we would do the math on it. And so an IPP is not right for everybody. It's a really good tax savings opportunity. Like again, you're deferring taxes, but each person's individual on how much they can contribute, if it's worth it or not. Again, if they are maxing out on how much for their CPP and old age security and they're taking the rest in dividends or whatever it is, we'll do that analysis and say, okay, sitting with an accountant, sitting with everybody at the table, what works best?
Yeah. Okay. No, that makes sense. And I guess the other thing to note is that it's a tax deferral like an RSP, which if you're going to be at the highest tax rate until you die, all you're doing is deferring, you're not reducing tax,
Yeah.
depending on where you're going with your plans and work life, etc. So I think that's always critical because certainly the commercials we see in February imply that you're reducing tax, which is not actually true for many of our clients and many people in today's world, right? That's not
Yeah.
actually true at all. It's just deferring.
It's
Okay,
just
awesome.
deferring.
We'll let you get back at it, and I'm sure we'll have lots more questions. So don't forget to ask questions in the chat, and I'll make sure that Pamela has a chance to address them. Thanks.
Perfect. We're going to go into something called an RCA. I call it the cherry on top. So it's a retirement compensation arrangement, sorry. It is, again, it's a strategy. An IPP is not for everyone, an RCA is not for everyone, but there's strategies that I find people aren't talking about enough. And when I'm meeting with my clients, it's going through all the options that are out there and seeing which one fits. And so with this one, I'll give you a little bit of an idea. And of course, I have a scenario for you so we can put it into action. So these are really good for high income earners, for somebody who's getting a large severance package, business owners who are selling their corporation and they have money over and above what they can get for a lifetime capital gains exemption, or if they're doing an asset sale. So It is often used with players and professional athletes because they get really big signing bonuses. It's really good for expats, and it can be used for key employee compensation because it can create these handcuffs. So what's really good about this, if you've taken a lot of time to hire an employee and you want to make sure they stay for a while, or if you're a business owner who's going to sell your business, the new buyers want to make sure that your employees don't leave. So if you have some key people, we might set up an RCA for them. So because it's got some vesting to make them stay so they don't just leave. So like I was saying, an IPP is a supercharged RRSP, but an RCA is a supercharged IPP almost. You can put even more money into it. So why is it so powerful? You can put a lot more money into the RCA. There's no required retirement day. There's no forced withdrawals. There is no forced funding. And again, you can put more money in. So with, say, an RSP, you have to, at age 71, flip it over to a RIF. You don't have to with this. You can put your money into an RCA and never touch it, which is really good because, again, when I'm putting together plans, I want things in different buckets so we can pull from what we need to, depending on the scenario that the environment has created. Again, just like an IPP, it is creditor proofed and it's really tax efficient. So the contributions are not taxable to the employee. The contributions are tax deductible to the employer. And again, all the tax is deferred until withdrawal. It is a trust. So an RCA is a trust. You're putting the money into a trust. But unlike a normal trust, there's not that 21-year rule. So in a regular trust, every 21 years, all the assets within it are going to be deemed to be sold. Doesn't mean you have to, but from a CRA standpoint, they're going to deem it to be sold and you're going to have to pay the taxes as if you did sell it. With an RCA, you don't. So this is how money can just stay in it and stay in it and stay in it and defer those taxes. And for a corporation, if they're looking to sell and they want to try and clean out their passive assets, an RCA is a great way to do that. So an RCA is a little bit more simplistic than an IPP. IPP have lots of actuarial numbers and calculations behind it. An RCA does, but it's a little bit simpler. Ideally, what they want is they want to look from the time that you've been with that same corporation, your highest 3 years. So if you've been with them for 20 years, they're going to take your highest 3 years. If you've been with them for 3 years, it's only those 3 years. And that's how they calculate the funding room. This is an example. This is not for everybody, but as an example, if there was somebody who is earning $100,000 a year, their past service contribution room would be $420,000. And then on a go forward basis, they'd be able to put $54,000 into an RCA. If they're making $500,000 a year, their past service contribution would be $2 million, and they'd be able to put in $270,000 a year. Where something like this comes into play, I have one of my clients that his company was doing very well, but he has never paid himself $100,000. He's only paid himself $100,000 and not a penny more every year. So in sitting with him, I sat down and said, okay, you're going to be selling your business and you're going to have because the way he set it up, he's got a trust, he's got all stuff, but there's still going to be some money that he is literally just going to have to take in and pay tax on because there was nothing else set up. So what we're doing is for the next 3 years, he's taking out $500,000 of income. It sounds like a lot, but that $500,000 we're taking it and building up wealth personally outside of the corporation because everything he has is built up in the corporation. So he's going to be taking it. He is going to be paying tax on it for 3 years. After that 3 years, he's going to go back to $100,000. Don't care. I only need 3 years. But when he goes to sell his business, now I have $2 million from the sale of his business that I can put into an RCA, so he doesn't have to pay tax on it. Again, it's just going to be tax deferred. And then we have a strategy on how we're going to utilize it later. But so we, again, just set up for 3 years, $500,000, just so I could get this and more contribution room. There is a uniqueness to it. I know this sounds absolutely spectacular. You can throw all this money into it. You don't have to pay tax. There's no withdrawals that are mandatory. There's no mandatory contributions. Sounds great. There's always a hiccup. Everything has a hiccup. Nothing is perfect. And this is it. It's still a really good product. But what happens is you have the sponsoring company. So say, for example, it'd be my corporation. I can set up an RCA for my own corporation. I would set it up. I would take the money, whatever money it is, and I would put it into the RCA. And the RCA is an investment account, but it's split 50-50 between two things. So one is an investment account that we can put in a variety of different investments. It really is a lot of options. So 50% of the contribution goes into the investment account. 50% then sits in a refundable tax account. It's not invested. It basically sits with CRA and just sits there. So again, it's not invested. This one, absolutely invested. And then when you go to, you want to pull out money, great, you can pull it out. So when you say you want to take out $50,000, $25,000 will come from your investment account and $25,000 will come from your refundable non-invested account. And then you can take it. So again, the only downfall to it is that 50% is just not invested, but that's okay. There's zero risk to it. You know, you're not going to lose it with your investments if you make a bad investment choice. Okay. Let's go on to an example. Bob is an executive who's been working for the same employer for 15 years. His employer has been bought out by another company, and of course, his job is now gone. So they're giving him a severance package. He's getting $375,000 as a lump sum. And basically, he's going to lose a large portion of that to taxes. So you'll never guess, but we're going to put in an RCA, and we're going to put the whole severance and deposit it into it. So the full $375,000 put into the RCA, he pays no tax. The company gets to write off that $375,000. Again, the money is tax deferred until he decides to withdraw it. And he can, when he wants to withdraw it, he decides how much and when. Say if he decides to pull out $125,000 over the next 3 years. If he were to take this $375,000, take it as a lump sum, he would pay about 48% in taxes. If by taking out the $125,000, it brings his taxes down to 26.9%. And that's a quick example of how it works. But now let's look at Cheryl. Cheryl owns a shoe store in Ontario. She's been taking about $200,000 in T4 income over the last 5 years. She's not saved for retirement. She basically, as almost every business owner, they keep all the money in the corporation and they don't have a lot of personal wealth to it. And she wants to retire in 2 years. She thinks her business is going to sell for about $2.6 million, but her lifetime capital gains exemption right now in 2025 is $1.25 million. So she's now got $1.35 million that's going to be taxable. And if she's in Ontario, that's 53.53% that is going to be gone to taxes. So what do? Voila, we're going to put into an RCA. So based on her last 3 years of income, she's going to create $1.2 million of past service contribution room, plus another room available, and she's got $160,000 of past service contributions. So she can, anything over and above what the lifetime capital gains exemption is, she can put into this, and she can fit all of it in. And again, we strategically work this before she retires to make sure that we can create enough contribution room so she can absorb it. And then again, so if she were to take that full amount, she would have paid 53.53% in taxes. But if she decides to draw $75,000 a year, brings her down to 29% in taxes. Oh. And before I go on to questions, I just wanted to also say, with an RCA, you can, very similar to what you can do with an IPP. So if I set up an RCA within my corporation and I have kids, the kids can be part of the RCA, and then you don't have to sell the assets of it until your kids or your kids, whoever. Again, it's another way to create intergenerational wealth. And with some of my clients, we'll take the money, we'll put it into an RCA, and if they don't need the money, it can sit there forever. And then what we'll do, we'll set up some other strategies to help offset the taxes that will be paid when they actually pass away if they don't use it all up. Okay, questions. Anybody have any questions?
Yes. Okay. So just for clarification then, when you have when you said that 50% is invested and 50% is not, does that mean that like the return on this is significantly lower than what you'd anticipate if you're investing then?
It could be. So again, if you are somebody who is a very high risk, aggressive investor, and you like getting 10%, 12%, 20% rate of return, you're going to be cut in half because half of it is not invested. But if you're more of a conservative investor, then again, and you're getting a 5% rate of return, half of it isn't invested. So it makes more of a difference if you're aggressive. If you're more of a low risk investor, you don't notice it as much. But yes, it kind of does cut down your investment, your rate of return in half.
If you're a if you're a low risk investor, you wouldn't notice it. Why again? Sorry?
You just wouldn't notice the difference in the rate of return. So again, if you're aiming for a 10% rate of return because you're very aggressive in your portfolio,
yeah,
because half of it's not invested, you only get a 5%. So that amount of return is just more significant of what you would see. It's more the impact of what you would feel in how much it grows.
But so, the part that's not invested has no return, like literally no return?
No return. But you're taking a whole chunk of money and not paying taxes on it.
But so you're deferring taxes again.
You're deferring, but you have a larger number that is invested. So if you have $1.2 million, you're not losing half of it to taxes, then investing it. You're taking that full $1.2 million and then investing it. And half of it it's not going away. You still have it. It's just not going to grow. So again, everything has its pros and its cons, but that is the big con to it. But for some clients, it is absolutely worth it because we can just put the money away and they don't really care about a rate of return. They just don't want to lose half of it. Some clients just aren't focused on what the rate of return is on the investment. It's more about sheltering from taxes.
Okay, excellent. Let's get back at it.
Okay. And here we go. We're going to go into another strategy. So IPPs, RCAs, and now an insured retirement plan. An insured retirement plan is exactly what you think. It's insured insurance. So it's all about insurance. Before I get into it, I'm just going to do a quick step back onto the two types of, in general, the two types of life insurance. You have term insurance or you have permanent insurance. Term insurance is really good for a short period of time, 10 years, 15, 20 years. So for example, if you have a mortgage, it's good to cover off something because there's a defined end to it. They tend to be cheaper because the likelihood of you dying within 20 years is lower than a permanent policy, which is guaranteed to pay out because it's going to stay for your entire life. It's 100%. In a permanent policy, 100% chance that you're going to die at some point in time. Term, less likely that you will die within that set time, so your premiums are cheaper. They have no cash value. You get insurance. It's like, I call it like renting insurance. You rent it. When you're done, that's it. It's like car insurance. Once you're done paying for it, you don't get anything back. Permanent life insurance is different. Permanent life insurance will cover you for your entire life, In general, depending what type of policy, but you can set your premiums and saying, I don't want to pay the premiums for this amount of time. It also has a cash value. So you have the insurance policy, and then deep inside is a cash value. And this cash value can help make your death benefit. So if you get a death benefit of $500,000 and you got a cash value that keeps growing, your death benefit will increase past $500,000. Whereas a term policy, you get a $500,000 policy, it stays like that for the entire duration. So this one can grow, and you have a lot of more flexibility in what you can do with it. Okay, so I'm going to focus on the permanent life insurance, and specifically a whole life insurance. You do have another option, which is a universal life. It's a good product, but it doesn't work as well for the insured retirement plan that I'm going to show you. A whole life is the ideal, the best one to go with. So that's the one I'm going to focus on. With a whole life policy, what you do is you pay your premiums. So you take your money, you pay the premiums on the insurance. And then within the insurance, like I was saying, you have a cash value. This cash value in a whole life policy is paid by dividends. So the insurance company, on how well the insurance company does and death rates and all their actuarial numbers, will come back and they will pay a dividend to the insurance policy. So that helps increase the cash value. And this cash value is protected by this insurance. So it is tax deferred. So again, you don't have to pay tax on it as it grows. Seeing a common theme, a lot of these are tax deferred. And then with the insurance policy, you can use it to buy out shares. If you have a business partner who passes away, you can use it to buy out their shares from their spouse. You can use it to pay estate taxes. So later on, things like this, if you have an RCA and it's got a big tax on the end, sometimes we can use insurance to pay that tax on the RCA or the IPP or whatever it is. You can use it to help support your family because your income is going to be gone because you passed away. You can also use this insurance policy as collateral for a loan. Banks love whole life policies, and they are very quick and very happy to give you a loan based on it. So they're securing the loan against your insurance policy. And what we're going to talk about is you can use it for retirement cash flow. There's lots to this one. So with a life insurance policy, again, there's a few ways you can access that cash. If you want, because it is an investment, you can just pull the money out and pay taxes on it as a regular investment. Or if you hold it in there, you can go to a bank and say, I'd like to borrow against it, and the bank will give you some money for it. And then when you pass away, the insurance plus the investment, they're all together. So when you pass away, it goes to your beneficiaries tax-free. And this is how we're going to start playing with this. Okay, so there's two parts to it: during your lifetime and then upon death. So during your lifetime, this is how it works. You put your money in, you pay the insurance, and in the insurance is that cash value, all that stuff, but you're just taking your money, you're buying insurance. And then you say, I like to take some money out, I'm in retirement, I like to withdraw it. But the bank says, no, we'll give you a loan. So you go to the bank, and the bank says, I will use your life insurance as collateral, and I'll give you this much money. And then you take that money from the bank loan, and you use it in retirement. But this is not income. This is money from a loan, so it is tax-free. You pay zero tax on it. And of course, the bank is not in it just because they want to give you money and they don't want anything in return. They're banks. So there is an interest rate on this. But the bank says, don't pay me that interest rate. You go take this money, you live on it tax-free, do whatever the heck you want with it. And then you get to do whatever you want with it. And then when you pass away, that loan is paid off by the death benefit. So how much money you've taken out and all the interest that has accrued is paid out of the death benefit, and anything left over goes to your estate tax-free. So what I'm doing now, you're going to bear with me, is I'm going to keep layering this and show you how we can start pulling in some of these strategies.
I'm going to interrupt quickly. So
Yep.
if, at this point, if you do the insurance policy personally, you'd be using after-tax dollars. But if you do the insurance policy within a company, you have not paid tax anywhere here. Is that correct? Or
You would have paid corporate tax. So it is all the money you put into insurance policy is after tax money.
so if it's within the corporation, you potentially paid corporate tax as a corporation, but no personal tax as of yet. And of course,
Yep.
if you own the insurance package personally, that's after tax money.
Yep. And I set this up for clients who have it personally. And I've also set this up lots of times within a corporation. So you can do either.
Right. So there's some tax at the beginning of this life cycle, but then after that, there's been no tax all the way through.
Exactly.
Okay, keep going. Sorry, I just wanted to clarify that before you got into the next step.
No problem. Let's give you an example. We have Sam. Sam is 45. He's a non-smoker. He's an employee and he's an accountant. He earns about $200,000 a year. He's married. He's got 2 kids and he is absolutely living his best life. And so he says, I want to retire at 55. I'm not waiting until 65. I'm doing 55. So and the reason why I'm picking these numbers is because I want people maxing out their RSP contribution limits. So again, the max he can put in 2025 is $32,490 into his RSP. He maxes out his TFSAs each year, and he also invests $20,000 a year into non-registered. He does have some life insurance through work, and he also has some mortgage life insurance. His main priority is he wants to make sure his investments are working as effectively and efficiently as possible. So again, taxes. What if we took that $20,000 a year that he puts into his non-registered and we instead put it into an insured retirement plan? So what would happen here? Again, he takes his money. Okay, take a step back. Sorry, I'm getting ahead of myself here. We're going to say in his non-registered, let's look at what he is currently doing. So he is currently taking the $20,000 a year, and we're only going to say he's doing it for 10 years because he wants to retire in 10 years. So no contributions after that. So $20,000 a year. Let's say he's getting in his investment a 5% rate of return. And then when he goes to retire, he's going to be pulling out $25,333 from age 65 to age 80 because he has other investments. So this is just part of it. I don't recommend setting up an insured retirement plan as your only source of retirement income. This is one of, again, the pockets, the different things that I like my clients to have. This is just one of them. So, and then his marginal tax rate, let's say, is 32%. But what he would do now, he takes his money, he invests it, and then when he goes to retire, he starts withdrawing the money. And then if he did this based on all of this, at death, say he's 85 years old, he will have, what is this? It's so small on my screen, $19,000 of assets left. That's all the non-registered is going to be worth is $19,000. So he pays a little bit of tax and it goes to his estate. Okay, what if he takes that $20,000 and buys an insurance policy? So instead of taking that money and putting it into a non-registered, he takes that $20,000 and he buys insurance. So that is he has decided this is how much money he wants to pay for his insurance. He's only going to pay that $20,000 for 10 years. The dividend yield rate right now in this illustration is about 6.25% is what the insurance companies are paying as a dividend. But he's also going to be withdrawing $25,000, the same as here. We're keeping this exactly the same. But by paying this $20,000, we create a death benefit that starts off at $313,000. Putting $20,000 in, it's an insurance policy, so of course he's going to have a death benefit. It works out to be $313,000, but again, as the cash value grows, that $313,000 death benefit is going to increase over time. Let's see how it works. So he takes his money, instead of giving it to put into an investment, he gives it to the insurance company. then cash value and the insurance policy sits here. And then he goes to a bank and says, give me a loan against it. The bank says, absolutely. We will give you $25,000, the exact same amount, every year from age 65 to 80. Then when he passes away, that insurance policy that started off at 313 and he dies at age 85 has grown to $1.2 million. The loan, again, the interest rate on the loan is 5%. It just keeps growing and growing and growing because he's borrowing $25,000 and there's a 5% interest rate on it. So when he dies, he owes $764,000, but he's never paid it out of his pocket. It's just sitting with the bank. They're just sitting on it, just letting it grow. So when he dies, there's $1.2 million. It's first paid off by to the bank, and then his estate is getting $481,000. So in this scenario, with the same amount of money, going in, same amount of money that he is getting in cash flow in retirement, he is up $462,000 compared to the non-registered. I've got lots of examples, so we're going to keep building on this. So behind the scenes, I want to show you how this works. So what he does is he puts in the $20,000 until he's age 55, and this portion on the left is his non-registered investment. The portion on the right is the insurance policy. So what's happening, as you can see, the insurance policy grows to $20,000 by the end of the first year, 42, and it just keeps growing. And then at age 65, he's pulling out $25,000. So if he were to pass away at age 50, the non-registered would be at $110,000 that his estate would get. If on the insurance side, it's growing, this is the death benefit and the cash value. But if he were to die, his family or his estate would get $343,000. So 110 versus 343. And of course, this internal rate of return is because you got a death benefit, so it makes the rate of return if you were to pass away so much higher. So I don't really care about those. What I care about is how much is he going to get, how much is he putting in, and what does his family get? So on the next one, this just keeps growing and growing. So in here, you can start seeing, this is the loan, $25,000, and it's growing over time. So it's 25, then it goes to 51, 79,000, 101, 109,000. But again, we don't care about that. This just keeps going and going. Say if and then he just stops taking out money, we stop taking out the loan. If he dies at age 90, which is right here, there would only be $22,000 left of this non-registered account. But again, as we showed before, we have what the death benefit is minus what the death benefit is 1.4 million. The loan is now at 976,000 because he stopped taking it here, but the loan just still keeps growing. His estate is still left with $521,000, whereas here they're left with $22,000. So in Sam's situation, we created a lot more, we created the same amount of cash flow, same amount of money being put in, but we've created a lot, he gets a lot more money at the end for his family. So before I go on to adding to this, anybody have any questions?
Awesome. That was very well laid out, actually, and I enjoyed it thoroughly. So a couple questions, and if anyone else has questions, please do let us know. We still have 15 minutes of this chat.
I do have. Okay, I do want to show you the next strategy because it goes into donation, and this is going to kick it into high gear.
Okay, perfect. So the one thing to point out about this life insurance is the example you even gave was an employee. So that's not just for the business owners, that's for all of the people that are also, well, it's for the business owners too, but even people who are earning employment income, it is valid and applicable to. If the person, I can't remember the name of your dude, but if he was a bit younger and or maybe had more realistic retirement goals like 65 or 70 or never, what's your thoughts on doing a similar type of thing, but actually taking the loan and using it to invest in the market? Do you have clients that do that? What's your thoughts on that for people who are, less risk adverse or younger, or just not planning to retire at all?
Absolutely. You can also, so if you decide to do that, again, because I'm going to throw this out there, some people don't have great credit, or they have other sources, or they have too many lines of credit because they have rental properties, or whatever it is, whatever reason they have, the bank's like, I don't want to give you a loan, but they will against this life insurance. So if they really wanted to kick it into high gear, they could take out a loan before they retire at any time, go to the bank, take out a loan, and then take that and invest it into the non-registered world. Absolutely. And then again, the interest that the bank charges is tax deductible because they borrowed money to invest. And then at any point in time they want to pay it off, they can. The bank will just keep accruing it, but if you want to pay it off, just pay it off. You can pay it back and then you're back to zero again.
Excellent. So one of the members is asking if you could clarify if the goal of the insurance investment is to maximize the money you leave to your family, or is it to maximize your own cash flows in retirement?
Depends. It really depends. So every time I set them up, again, we're talking about the financial plans. We look at the whole plan of what is the big goals. Again, are they setting up an RCA? Do we need to pay it off later? Do they have a cottage they really want to keep? Do they just have some money they want to leave to their kids, or do they want to use it all for retirement? Because look at I'm an only child, and my parents, when I sat down doing the plan, I always asked the question, what do you want to do with your investments? Do you want to leave an inheritance? What is important to you? And my parents said, heck no, you're not getting a penny from us. We're going to spend it. Fantastic. So then the insured retirement plan of utilizing as much money as we can with little death benefit is the strategy we would take. So you can use it for so many things. I have people who use it, and that cash value, they might take it and get a loan or withdraw it to use it to help their kids with the down payment of a home. But then you still have your life insurance that stays in place. So it's a really strong tool.
Yeah, I think it's definitely misunderstood and not leveraged enough, is from my perspective. And I think, like, if I were to simplify it, and obviously we have the opportunity to share this deck and people can rewatch this video after, and you did a great job of outlining it. But the way I would simplify it is, if you have liquidity to make investments, stop and think about insurance and make sure that the decision is wholesome, with insurance as a possibility, not just direct investments, because you can potentially do both through that loan and getting liquidity. So that's kind of the summarized version of how I look at it, is that don't just invest, consider insurance and consider loans that tie with that insurance, and you can have the same liquidity, same lifestyle, more at the end. And it's creative, but it's also designed to work this way, right? And I think a lot of us don't think about it. Or if you do have a wealth advisor who doesn't look at the wholesome insurance plus investment, then you may not be seeing the whole picture.
Yeah, there are I am giving some strategies. There are so many more. And I'm going to show you a donation strategy here. And
Perfect.
Again, it's going to be utilizing the insured retirement, the insurance policy again.
Right. So for those of us that want to die broke and leave nothing, like your parents and me, this is another way to make good in the world without spoiling your children.
So I know for the essence of time, I'm going to go through this bit quickly, but people tend to forget the power of a donation. And in Canada, our donation tax credits are really good. I know a lot of people here might understand it, but just keep it top of mind that you really do have an opportunity. So if we look at Alberta, we have one of the highest tax credit percentages, like how much we allow out of all the provinces, and not enough people are utilizing this strategy. Okay, again, I'm going to go fast. This is talking about investments. And so I'm going to take the donation thing, and I'm eventually going to be adding it to the insured retirement plan. So just bear with me on this. So this is just a little bit of an example of how people need to start thinking of the bigger picture when, again, if you have investments and you need a financial planner. So we have Denise, who's making some money. Basically, the sum is that her mom got sick and she really wants to give money to the cancer center, but she doesn't have a lot of cash flow. So, but she has some money. She's got one mutual fund in her non-registered sitting at $5,000 and she wants to donate that. So there's two options. You can go in and just sell that mutual fund and then after tax proceeds, give it to the charity, which is what a lot of people do. They're donating their cash. But you can take the actual mutual fund and you can donate the mutual fund to the charity. So you are not selling it. So the charity is now going to hold that mutual fund and they become the owner. So quickly going through this. So if she only paid $1,000 in the mutual fund, it grew to $5,000. She's got a capital gain of $4,000 in either scenario. If she were to just sell it, she'll pay the tax, and then the charity's only going to get $4,080. And then she has a tax credit of $1,800. But if she donates the security, the mutual fund as a whole, isn't sold it, so there's no capital gain on it. She gets the charity gets the full $5,000 and she gets a credit for $2,300. So again, it's just some of these strategies that if you have investments, talk to your financial planner. What can we use in the whole gamut of tools to really create some tax deductions for you? Okay. This one, let's sit down. This is the same example as before, same person. He's got, okay. So if Sam is investing $32,000, $490 into his RSPs every year, what if he donated it? So if Sam is making $200,000 a year, he donates $32,000. The charity's going to get $32,000 and he's going to get a tax credit of $16,000. I'm going to go through this a little fast. If he were to do it on his own, if he were to take the $32,000 and put into an RSP, he would get a tax deduction of $13,000. If he donates it, he gets a tax deduction of $16,000. So right away, he's ahead in the game. Okay. So he's donated $32,000 to the charity. He gets a $16,000 tax savings. What if he takes that tax savings and buys life insurance with it? So again, it's the same thing. He's putting that $16,000 in, only doing it for 10 years because he wants to retire in 10 years. Then with that amount of money, say it accrues, and then at age 65, he can pull out $20,000 a year. And he's going to do it from age 65 to 80. Oh, sorry, my screen is not showing up. 65 to 80. So he's doing it for 10 years. I'm just going to do the summary. I'm not going to show you the screen. Taking that $32,000, donating it, he gets a tax credit, uses that tax credit to buy life insurance. That RSP would have given him about $221,000 after tax. In this one, he got $307,000 tax-free from the insured retirement plan. So that $20,000 times 15 years, he got that. It didn't cost him any money out of pocket to buy this life insurance because he took the $32,000, donated it, took that tax credit, and then used that tax credit to buy this life insurance. And then the life insurance is giving him a cash flow of $20,000. And then if he were to die, the death benefit at age 90 is, gross, I think it's about $422,000. So when he dies, he's gotten $32,000 times 10 years. The charity has gotten $32,000 times 10 years of tax deductions. I'm going fast. The charity got $32,000 of donations. Plus, when he dies, if he doesn't want to leave the life insurance policy to his family because he's got enough money, maybe he wants to donate it, then that gets donated. So at the end, he would have, for the same amount as an RSP, he still would have gotten $20,000 of tax-free income for 15 years. he would have gotten the tax credit, and he would have totally in whole donated $747,000 to a charity for the same amount of money that he was putting into an RSP. He was able to help out charities, and he was still getting cash flow, tax-free cash flow in retirement. And I'm going to leave it there. There's lots more I can do, but I'm going to leave it there because we are way over on time. I'm so sorry.
No, we're good. Well, we're over, but we're not, so we're good. We have 4 more minutes that we can chat. So, couple quick questions. If Sam does this that we've got on the screen here,
Yep.
and so he's got his 16,000, but he still has RSP room then because he's not, right? That's the other
Absolutely
benefit if he had another reason to use his RSP for something else.
Yeah, so absolutely. So if he still had, he could still put in $32,000 into his RSP, and he could still take that money, say another $32,000, and give it to a charity. Absolutely, because none of this affects his RSP rate.
And build up his RSPs for future use if for some reason that came into play.
Absolutely. So in the Sam scenario, one scenario he was taking the RSPs, another scenario he was just taking the non-registered and just seeing how the two could work, or just redistributing the money.
In the examples that you're giving where like she gives it to the cancer center or what have you, does the cancer center have to be prepared to accept a mutual fund and able to accept that donation in that form of a financial asset?
Yeah, so it's what it is there is lots of foundations. So in general, this is what I use all the time. There is this one donation center where you can give your money, you get the tax credit, and then they manage it. And you create this like platform for you. And you say, I'd like to donate this much to this charity, and you can pick. If you don't know, it can sit there and you still get your tax donation at the beginning. And then you can just choose 5-10 years later, 1 month, 2 months. And that company, they manage the stock portfolio for the cancer center.
Okay.
Some charities can manage it on their own, absolutely, but some can't.
So whoever is receiving would either have to be at the foundation type or able to accept a financial asset. So that part would have to be worked out.
Yep.
Yeah. Okay, cool. All right. This has been excellent. I love that we hit these 3, and obviously we hit them fast and at a high level. So that's okay. No, this gives everybody something to think about. And there was many that relate to business owners so that we can support our clients and or our bosses better and ourselves if we are a business owner. And then there was lots that actually were applicable to you as an employee or just as a person with a family and building up wealth. So very applicable to everybody that joined, and I really, really appreciate. As mentioned, we'll make sure that the video and the deck goes out. We always do. And of course, if you want to get deeper and understand what Pamela was illustrating at that next level of understanding, please do reach out to her. She's got her information on the screen, but it'll be also in the deck and the video that we send out. So please do contact her for that next level if you would like to discuss it further. This was very exciting and awesome. I really do appreciate you coming and joining us, Pamela. It was awesome to talk through this. And for everybody that made it out to our webinar series over lunch here, thank you. I know that it's the Monday after a long weekend, so you're probably a little bit more disjointed than an average Tuesday. So thanks for taking the time, and hopefully this gave you something to go home and talk to your spouse or others with. I'm certain that I will make JD watch this, so he's got homework.
Perfect.
Thank you, everybody. We will see you again for the last of the season in June. And of course, the Acumatica Lunch and Learn as well. Both of those links are shared in the chat. We've got Lunch and Learn for Acumatica June 2nd, and on the 3rd Tuesday of June will be our last webinar of the season for Shred. Very excited to have everybody here, and the support is always appreciated. Thank you, Pam, and thank you, everybody. Take care.
Bye, everybody.